Okay, in this session, we will speak really quick about some models of delivery of healthcare, and we will focus on the insurer part, the insurance plans, and the types of insurance. Most of the ideas, types of insurance are coming from the systems that has been established in the United States as a progression of the different types of payment and insurance. I will not get into details of model of care, but we will mention quickly, really quick, the accountable care organization, which has been mentioned earlier in other sessions as well. Okay, the main idea of insurance, you can let's start by saying that there are three parties, three sides to when we think about health payment, health cost payment: the patient, the provider, and the insurer or the payer. So the patient gets the benefit, the beneficiary, usually the term is used. The provider, the healthcare provider, which means the physicians, the clinics, or the hospitals, and the insurer, the payer, the side who pays really for the cost of the healthcare management. How do insurer look at this aspect? In reality, insurance company are for the most part commercial. They might not make a lot of money, but they have at least to cover the cost of their service. Of course, they have to make money to cover their operation as well. In any case, how they look at the issue of insurance. One of the main fundamental ideas, the essence of how insurance company deal with insurance, is determining the risk. So the term risk is very important. It is a central idea of the analysis of insurance. The risk, as defined here, the risk is the potential that a person will get sick or require health services and will incur bill cost associated with his or her treatment or services. So theoretically, everyone is at risk of developing disease, getting sick, and require health service. For insurance company to give a price for insurance policy, they need to determine what risk this person has, so they can determine a price. So it is very difficult to determine risk if this person is a standalone person that the insurance company needs to cover. So instead of looking at one person at a time, insurance company likes to look at a group of people and consider them as a pool of risk pool. This is the term that they use. At the end of the year, some of the people in this pool get sick, some others they don't get sick and they just pay the insurance, and the cost of the health management is covered by the collective payment of this pool. So insurance is a system of reducing persons' exposure to risk. This is from the patient side. If I am a person who goes and buy insurance, I am trying to reduce my own risk of getting sick, and I have to pay for myself. So insurance is a system of reducing person exposure to risk or loss by having another party, which is the insurance company, assumes this risk. So they take the risk off your shoulder in this, if you can imagine this scenario. As I mentioned, we need to consider three different entities: patient, provider, and payer. When we think about insurance, the patient is the one who benefits, the provider the one who provides the service, and the payer the one who pays for the service. All three parties have to deal with risk. We can have a plan that puts the risk on the patient, and we can have another plan model that puts all the risk on provider, or we can have a plan that puts all the risk on the payer. But to be fair, what happens is we always try to distribute the risk between patient, provider, and payer, so the system is balanced. So if we consider these three entities, let's read this statement. When the cost of health services are learned after the care is provided, a third-party payer, the insurance company, is at risk. So if we don't know anything about the cost of the service, and the insurance company is insuring a person with unknown risk, he might get sick, and his treatment cost a lot. So the insurance company is really assuming the risk and taking the whole risk. Let's read the second statement. When providers must project the cost of treating patient into the future and contract to provide all care to those estimated costs, the provider is at risk. So we might, insurance company might come to the provider, the hospital, and tell them, we will pay you a certain amount of money fixed, $1 million, for example, to cover the cost of 100,000 people. This is it. Who is at risk if we do this? The provider is at the most risk, because the provider doesn't know what will happen throughout the year. They might spend a lot more than $1 million, or they might not spend that much. So who is really getting the risk? The provider is the one who is getting the risk. Let's read the third statement. Patients assume risk as they must pay higher and higher percentage of the cost as their share. So if I don't buy any insurance as a person, if I get sick as a patient, I will handle the risk myself. So all the risk is on my side. So you can imagine how do we really distribute, what is need to be done to distribute the risk between patient, provider, and payer. In the United States, health insurance is usually tied to employment. So people usually are covered, they get health insurance from their employer through employment. Many large employers, as part of a package of employment benefit, pay a portion of the health insurance premium. Employees may be required to pay extra for health insurance for their spouse or children. So this is again to distribute the risk. So let's say I am an employer and I have many employees. I have 1,000, I own a company and I have 1,000 employees, and I need to buy insurance for them. If I buy the insurance as a company, I take the whole risk on my own. But what happens usually is as an employer, I pay for part of the premium, and I ask employees to pay extra for family, spouse, children, etc. So I try to, as a company, I try to distribute the risk between myself and the employees. The the payments are expensive. Therefore, people without jobs are unlikely to have adequate health insurance. If I don't work, or if I own my work, I have income, self-generated income, and I need to handle my own health. So I might choose not to buy insurance, but in this scenario, I take the whole risk. If I get sick, I have to pay for everything. And if I go and buy insurance, because I am not in a pool of risk, the insurance company ask me to pay higher fees because they cannot estimate my risk, and I end up by paying higher premium for health insurance. What I'm trying to say really, this is another way of saying it. We deal with insurance from risk pool point of view. What is the risk pool? Risk pool is a group of individual entities, people, employers, or associations whose healthcare costs are combined for evaluating financial history and experience in order to determine premium. So instead, if I am insurance company, instead of dealing on personal basis one by one, I take the whole group of people and put them as a risk pool of risk, and I divide the estimated cost between them, so I can distribute the risk on the group. There are three types of pool that we can think of. Individuals, these are self-employed people or people who work for companies who do not offer insurance. So this is, let's look at it that this scenario is the worst for the individual, because insurance company cannot determine the risk of these individual because they are not in a uniform pool. What happen if people work in a company? Usually there are shared features between them. They have similar lifestyle, similar conditions, so the risk pool is somewhat in a known range. But if people are self-employed individual, they are there is a wider range of variability that the insurance company cannot determine the risk with accuracy. So what happened? They tend to ask for more money for health insurance. The second type of pool is large employer pools. Let's say a large company who has 2,000 employees. The example here is employee 1,000 member or more. When this company buys health insurance, they buy insurance for the whole population of 1,000 people, and the insurance company are more comfortable to issue insurance policy for 1,000 people because the risk is distributed. They get paid for 1,000 person, but at the end of the year, few or several of these people get sick, and the cost of the health insurance is usually, or this is the expectation. It is expected that the cost is covered by the payment of the 1,000 people. The third type, multiple employer pool. Insurance company might combine some types of people into one pool. Employees from several mid-sized employers. The insurance company might combine different employers of the same character, and they put them in the same pool, and they provide the same insurance policy and price. I hope the idea of risk pool is clear, because this is really the fundamental idea how insurance company deal with health insurance plan, how they price them. Okay, individuals. If I am not covered by my employer health insurance, I mean, and I am individual or I am self-employed business person, I have to purchase my own health insurance. So the risk pool is generally not very well calculated or estimated. So insurance company tend to give me high price. They will ask for higher price because the risk pool is not calculated. The estimation is not accurate. Usually have to provide evidence. In addition, I have to provide evidence of insurability, provide info about current and past health status, and must undergo physical exam. If I am already sick or having chronic disease, insurance company might refuse to provide insurance for me, or they might ask for higher insurance price. Company may reject, insurance company may reject the application, or may specify specific clause known as exclusion criteria. So they exclude some condition. So they might tell me, okay, we will insure you as an individual, but we exclude any cost of your chronic disease treatment, because I am already sick. So it is in this matter unfair for the person. But what is the idea? The idea is the insurance company cannot handle the risk altogether. They divide the risk between the individual and the insurance company. The second type is employer based. As we mentioned, there is a large company, a typical example, a large company with thousands of employees, and this large company buys insurance from insurance company. It is group plan for the group of employees or member, purchased by employer for a group of employees. Usually it is a group plan, and the pool now is better estimated. It is clear, and the estimation of the risk is better because you have a pool of people that you can estimate the risk, especially if there is previous record of these employees. If the insurance company already has insured those employees for the last few years, they know what risk pool they are dealing with. These plans have a lower premium. That's why it's much cheaper, because the risk is distributed between thousands of individuals, and less deductible, and greater benefits than private healthcare plan. We will come to deductible later on, what it is. What does a health insurance policy address? If I buy insurance, what is written in health insurance policy? Let me quickly go over these. Of course, definitions of terms, the eligibility, what I am eligible to receive. For example, dental care frequently not covered by insurance plans. So if I need dental care, I need to pay extra for extra payment for insurance for dental care. Eligibility for care and enrollment, specify who is eligible for insurance and the procedures that need to follow. So I might need to get approval for a treatment before I receive it. If I get sick and I go to hospital, insurance company might require approval, their approval before I receive the treatment. So there are different procedures taken by in different insurance plan. Eligibility is often depend on the position or duration of employment. A common provision is that persons must be employed at least 50% or half time to be eligible for health insurance. Okay. In the policy, usually there is a list of benefits. So what are the benefits that I receive as insured person? Policy outline the benefit: hospital care, supplies, medication, ER care, transport service. So I might choose insurance plan or insurance policy that does not include, for example, medication, does not include dental care. So there are different benefits that I receive with each policy. The term premium is used to describe the payment, the price that I need to pay to buy the insurance. The term co-insurance is used if I have two different insurance companies covering my health. For example, I work in a private company who buys insurance for me, but this insurance does not cover dental care. So I go to another insurance company to add more coverage or more benefits. So this is called co-insurance. I have more than one insurance company covering my cost of health management. The term co-payment, let's get back to the idea of distributing risk. Co-payment, it means that if I go and receive treatment, I need to pay a certain amount of money before I receive the treatment. So in one way or another, this reduce the risk on the insurance company, because although I am a beneficiary, I receive benefits, but I still have to pay a percentage, usually percentage of money. So if my treatment cost $1,000, I might need to pay, for example, $10 or $20 as a co-payment. The term deductible is similar to co-payment, but it is different in the way it is paid. Deductible similar to co-payment, but it is paid by the person as a fixed amount as a minimum payment. Let's give you another the same scenario. I go to a hospital and I need to receive treatment and it costs $1,000. The deductible is 100. So I pay 100, then the insurance company pays 900. Then if I go a different time and the cost of the service is 100 only. So in this scenario, the deductible is 100. I have to pay 100, and the insurance company does not have to pay anything. So deductible is a fixed amount of money that I have to pay, and above this amount, the insurance company covers. Co-payment is usually percentage that I need to pay, and the insurance company covers the rest of the payment. Maximum out-of-pocket expense, it means that I don't have insurance and I have to pay the entire cost of the entire price of the treatment. Limitations limit to the extent of we are talking about what the insurance policy include limitation limit to the extent of benefits can be placed on total dollar amount or time frame, i.e. purchase of durable medical equipment more than 500 require prior approval. So these are the content of the insurance policy. There is also exclusion criteria in the policy. The policy might exclude some type of procedures that not included in the coverage. Situation that the health plan will not cover the service. Example, experimental diagnostic or therapeutic procedure, medically unnecessary procedure, sometimes, like I mentioned, dental care or plastic surgery, if it is not considered necessary. Procedures explain how policyholder obtain their benefit. That might include, as I mentioned, some insurance company require prior approval before the person receives treatment. Coordination of benefit if there are multiple health insurance coverage. If I am covered by more than one company, I might need coordination who will pay my cost. The policy usually include appeal process if there are issues of denial of coverage or rejection of a claim. So there are appeal process. EOB is explanation of benefits. It's a document that is part of the policy. After healthcare service were received, explain how health insurance company determined its payment. Details what insurance covered and what portion of the payment in the policy holder is responsible for. Okay, I will stop as part 1 this, and we will continue with the same session in part 2. I will make another video as part 2.